Hey traders, this is Ron Haight. Hope you guys had a fantastic day today. As always, nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk, and specific financial issues should always be addressed with your financial advisor. All right, SPY, the markets. The S&P 500 ETF was down 1% today on a pickup in volume, though we did come off the lows. This was on the heels of the Fed saying, hey, we're going to lower rates by about 0.25%, and we're probably going to stop there. This has been going on for quite some time. If you think about it, going back to December, I'm going to have to go back and show you guys a 2-year daily chart. Here is where we were. Then there were fears of the trade wars, the same stuff that they were doing over here. Then there was fears what the Fed may or may not do. And then we had this pretty big sell-off from SPY 290 all the way down to 235. Big buying opportunity, right? Then we start rallying and same old stuff. The world's going to end. Then we come back down. Now we have a one-day sell-off. We come back down again. In my opinion, if you listen to all the talking heads, and man, there were a bunch of folks talking baloney on CNBC and other places today, all offering their personal opinion as if it was gospel. I prefer to trade what I see. I can have my own opinions, but what's the big money doing? What's the majority of the money doing at this stage? Personally, I'm super bullish yet, still long-term bullish. But I said keep an eye on the red line. That's going to be the first line in the sand. I believe it's going to tell us something is up. Well, that red line is the 20-day EMA. And we got below it today. If I zoom in even further, you can see we dipped all the way down to 295. We were down another 2+ points at one point today on the SPY. We are below the red line. That is the yellow flag warning to the bulls. They have lost control of the daily trend right now. However, we ironically stopped right at the last little swing here, just from back on the 19th and the 18th of July. At this point, the 50-day is going to be the big target. That's down there right around 291.5. About 6 points lower. So sort of not quite twice what today is, but pretty close to it. We get below the 50-day, then things start turning more bearish on the daily chart. If I take you back to the May sell-off, we hit the 50, we bounced, we got below it. Remember, the 50 is the orange. We tried to get back above it, got stuck at the 20-day, then we hit the 200 in purple. Then once we regained the moving averages, we were off to the races. Well, if I take us back over to the sell-off in October, we hit the 50 in orange. Remember, institutional moving average, bounce, bounce, break it. We even broke the 200-day in just 2 days. That was a huge move. Then we had a little relief rally, broke it again, fell further, tried to get back above the 50, couldn't, fell back down, tried to get above it one more time, fell back down. And then this was the ledge I talked about back in December. We want to watch 260. The moment 260 fell on a closing basis, it was just boom, down 250 S&P points or 25 SPY points. Christmas Eve bottom, and now we come back up. Another metric that I use to try to determine where's the momentum, we can also use, now I have the 8-day on this chart. Sometimes I do the 5-day, but when the 8-day crosses down through the 20, that's a mini sell signal. That happened back there in October. It happened back here in May. And it hasn't happened over here yet. If that happens, that adds more weight to the bearish case. And another one that happens is when the red line crosses below the orange. That's a 20 period crossing below a 50 period. That's also a bad sign. Doesn't mean the world's going to end. But when you keep layering these moving average crosses on top of each other, it just adds more and more weight to the bearish. Now, what I will say is this. If the 8-day gets below the 50-day, that's a sell signal. We got to watch what happens if the stock hits the 50-day. We close below the 50-day. There is nothing to stop the market in terms of technical support going right back down to the 200-day, which are the May lows. I'm not saying it's going to get there. It could get 3, 4, 5 times as worse. We could go all the way back down here. Who knows? So we're just going to take it piece by piece. But if I was going out tomorrow looking for bullish directional trades on the S&P 500, it just isn't there. The close below the red line is your warning shot. Consider looking at protection, maybe via protective puts. Maybe I would want to trim some bullish positions, etc. Unless the stock you're looking at is technically bullish, this is the caution. Again, I keep saying that. This is that yellow flag. All right, here's the down 1.25%. So a little worse than the S&P, closed below the red line. The target's the 50-day. Now that's around 264. It's just more than what today happened. So a little bit more of today, maybe 1.25 to 1.5% lower. Get below the 50-day, then we go down to the 200. In purple, the Qs. Let's go ahead and zoom in on them. Also below the 20-day. There really wasn't a close call we're solidly below this moving average. So target 50-day down around 186. Below there, we come down to the 200-day. The IWM, believe it or not, was down less. It was only down 0.81%. It's still flirting with these previous highs. In fact, I mean, the IWM and the MDY have been underperforming for so long, they're actually still above their 8-day moving averages. Or the IWM is, the MDY just barely below it, but they're still above their 20-day moving averages. So overall, these guys are holding up pretty good. Now, XLF, banks. When the market was selling off, I was watching the banks. The Dow was down about 300 futures in the futures market, so about $3 on DIA. XLF was still green. Very, very interesting. It only finished down 0.5%, and it's above its red line. They often say that when Fed Day occurs and there's a movement, the following day can be a reversal. We'll see if that happens. But even though the banks are holding up better, the fact that the Dow, the S&P, and the NASDAQ are already below 20 days, hey, bears get the edge right now. Bulls have lost their edge. Bears are starting to gain the edge. If we look at gold and the miners, GLD was down 1.31%. It's back getting inside its bull flag here. I would be careful right now on GLD. We did close barely below the red line. The red line was at 133.31. We finished at 0.21, 10 cents below. This puts you on notice on GLD as well. The gold miners, they were down 4.78%. This was a hot knife through butter. We cut right through that 20-day. This trend is dead on the daily chart. It's over, period. Once we got above the 50-day here on May 31st, it's been great, and now it's over. If we look at silver, SLV, remember it's been lagging, hasn't been coming back as much as gold. It's still above its red line. I could still potentially be bullish on silver, but I got to tell you, if gold's rolling over already, the gold miners are rolling over, it's hard to remain bullish on the daily chart on silver. SLV down 4.62%, cut right through that red line. Again, hot knife through butter. The support area would be right back here in this consolidation around 26, which is going to be where the 50-day is going to be coming in probably in a day or two. Now, one quick thing. I want to look at the VIX, $VIX. The VIX was up 15% today. It's hard to use previous highs as resistance or previous lows as support. Pretty much the basement seems to be 10, 11, 12, 13 on the VIX. Upside from the May sell-off was in the 20s. But with this kind of move, what I would tell you is this. We have an 8-day and a 20-day crossover occurring, or will tomorrow. Today, this big up move, that's a breakout. It's also boding bullish for VIX, bearish for equities. So the VIX is not in a divergent situation where it's not coming along for the ride. It is coming along. It is going higher. All right, now, dollar, euro. Had a question on US dollar via UUP. It's bullish. It doesn't adhere to moving averages very well, but the overall trend, if you go back to April, has been pretty much up, right? It's staying above the 200-day. At this point, maybe a close below the 200-day in purple would signal maybe a trend change. But I expect the dollar, in my opinion, to keep going way higher. Euro has its problems. Other currencies have their problems. The US dollar is still the world's reserve currency, and the euro down 0.8%. Now, we also have Brexit issues too. FXB, it had lost quite a bit 2 days ago, which would have been Monday. It broke down again, but my opinion of FXE is below par, below 100. I don't know how much lower, but I've been saying that for a couple of years. It's getting there eventually. There's going to be these ebbs and their flows. But dollar bullish, euro bearish, and TLT bonds. It had a little pop up today. This is still considered a bull flag. This could potentially be the flag. This is the flagpole. Watch the 50-day. The reason I say the 50-day, nothing works all the time. You can see over here it didn't, but ever since getting back above it in March, we have not closed below it. So we have 1, 2, 3, 4 months worth of data supporting the 50-day as support. Below the 50-day TLT, that would be then bearish. Apple and Google, I was reading a report today that said Google now has more cash than Apple. Specifically to Apple, this box was the overhead supply, right? That's what I talked about. I'm going to delete it. Well, look what happened. We were up as high as over 220, finished down $7 off those highs at 213. We got a black candle, which means we did open higher on the day, but closed lower than where we opened, but it's still higher than the previous day. Therefore, it's not a red candle. I totally would expect this even without the Fed, because we had to get through all this chop. A breakout would still be above 230. And then Google, which is now reportedly the new cash leader, we've gone below that 726 candle. Target now is a gap fill. Yes, it could come down and hit moving averages and bounce. Big target's a gap fill. If it holds the 8-day and then closes higher, that would be a nice retracement and bounce. But then the 8-day would be a trailing stop. So we'll keep an eye on that one. As for stocks that had good days today, Kohl's. Retail stocks were up. Kohl's was up 1%. Still looking good. Remember, the close here was 54.39. We are now within about 60, 70 cents of that for a gap fill target. Abercrombie up 0.8%, doing just fine. And there was news on Nordstrom's that the founding family is taking a bigger stake. This stock surged 7.89%, huge volume. I mean, the gap fill now at 37.50, which 15% higher or so would be the target, and then all the way back up to the 200-day. Here I would consider a 20-day EMA as an end-of-day trailing stop. So that's it. Fed day, lots of news, lots of talking heads. My opinion, put the fingers in the ears, hum your favorite song, and just follow what you see and not all the talking heads out there. So right now, the bears have the edge on the daily chart because we are below the 20-day EMA, target 50-day. All right, have a great day, folks. I'll see you in the next video.